What is the structure of the financial statements for different types of organizations? Recall that in your introductory financial accounting course, you likely covered the income statement, the statement of retained earnings, and the balance sheet for both a service and a merchandising organization. For the service organization, you completed a single-step income statement, and for the merchandiser, a multiple-step income statement. However, you've never been exposed to a manufacturer's financial statements until now. The titles of the statements for both a merchandiser and a manufacturer are identical. However, there are two main differences in the body of those statements. Note that the statement of retained earnings is identical for both entities, so we'll omit those from our analysis of the differences. Let's start by looking at the differences on the balance sheet. This is an example of the current assets section of the balance sheet for a merchandising organization. I've provided amounts for demonstration purposes, so please just focus on the structure right now. As usual, we can see the title, Merchandiser Inc. Balance Sheet Partial, December 31st, 20XX. Then the title, Assets, followed by the subtitle, Current Assets. Then the assets are listed, cash, accounts receivable, merchandise inventory, and prepaid expenses. Finally, total current assets. Notice that there is only one inventory account, merchandise inventory, also simply called inventory. It represents the value of the products on hand at the end of the period. Inventory which the merchandiser purchased from either distributors or the manufacturers who produced it. Merchandisers purchase finished goods from manufacturers or distributors and sell that inventory to the public. They therefore require only one inventory account on their balance sheet, merchandise inventory. The balance sheet of a manufacturer also starts with the title, Manufacturer Limited Balance Sheet Partial December 31st, 2000XX. You can see the same headings, Assets, and subheading, Current Assets. The listing of the current assets also starts the same, Cash and Accounts Receivable. But there is a subheading called Inventory. Under that subheading are listed three inventory accounts, Finished goods inventory, work in process inventory, and raw materials inventory. These are subtotaled before completing the listing of the current assets with the same prepaid expenses. You can easily see the difference between the merchandiser's balance sheet, with one inventory account called merchandising inventory, and the manufacturer's three inventory accounts, finished goods, work in process, and raw materials. Let's look at the definition of the inventory accounts used by a manufacturer. Raw materials inventory is the cost of all the physical materials and supplies that are used in the production process. For example, for a bakery, this would include the flour, sugar, eggs, milk, butter, and other ingredients required to manufacture a cake. Work in process inventory, sometimes called work in progress inventory, or WIP for short, is the total cost of all unfinished products, products which are currently moving through the manufacturing process. This is where a company accumulates all of the manufacturing costs for products which are currently being manufactured. Finally, finished goods inventory is the total value of all products which have completed the manufacturing process and are available for customers to purchase, such as the boxed cake from a bakery. Placed side by side, you can see that the inventory accounts are the only major difference between the balance sheet of a merchandiser and that of a manufacturer. There are no differences between the liabilities and equity sections. Note that I'm not showing a service organization's balance sheet because they do not carry inventory. What about the difference between the income statement of a merchandiser and that of a manufacturer? Actually, there are none. On the left, you can see an income statement for a merchandiser, and on the right, the manufacturer. Both start with the company name, the name of the statement, and the date, year ended December 31st, 20XX. Both start with sales revenue, and then deduct the cost of goods sold to determine gross profit. Next, the subheading operating expenses, under which they list administrative expense, marketing expense, and delivery expense, all the period costs which are expensed as incurred. This is followed by a subtotal called total operating expenses, and finally, income before income tax, also called operating income in management accounting. You can't see any differences between these two statements. Are there any? And the answer is actually, yes, there are. The difference between the two organizations is not the fact that they both use the cost of goods sold account, but in the way the cost of goods sold account is calculated. The best way to demonstrate this is through an example using a cost of goods sold statement, a statement which is used to calculate the cost of goods sold in each organization. We'll start with showing how the cost of goods sold is calculated in a merchandising firm. Of course, we start with the title, Merchandiser Inc. Cost of Goods Sold Statement, year ended December 31st, 20XX. The first line is the opening merchandising inventory of $144,000, also called beginning inventory. This is the inventory which is still on the shelf at the start of the period, equal to the ending merchandising inventory from the prior period. We then add in the cost of merchandise inventory which has been purchased during the period, $709,360. This is the value of all the inventory purchases the company made throughout the year, which is also sometimes called net purchases. Added together, this equals the cost of goods available for sale, the cost of all the inventory which was available for sale to customers during the year, $853,360. Deduct the closing, also called the ending merchandise inventory, $160,000. But wait, where did we get this value? We got it from the current assets section of the balance sheet. This is the inventory which is, as yet, unsold and remains on the shelf at the end of the period. Going back to the cost of goods sold statement, we deducted the closing or ending merchandise inventory from the cost of goods available for sale. By deducting it from the cost of goods available for sale, we get the cost of goods sold, $693,360. This is the value of all the inventory sold during the period, which is the amount we used on the merchandiser's income statement as the cost of goods sold. We've calculated the cost of goods sold for the income statement of a merchandising organization. Don't forget, this is the amount of inventory that has been sold during the period to customers. Now that we understand the process for a merchandising firm, let's move on to the process of calculating the cost of goods sold in a manufacturing organization. The title is identical, just changing the name of the company to Manufacturers Limited. A manufacturer still starts with the opening or beginning inventory, but for them, it's called opening or beginning finished goods inventory, $52,800. Same as for a merchandiser, this is the finished goods which are on the shelf at the start of the period, equal to the ending finished goods inventory from the prior period. But now, instead of using the cost of goods purchased, which is what a merchandiser would use, the manufacturer adds the cost of goods manufactured, all of the inventory which has completed the production process during the period and was ready for sale to a customer, $771,700. Added together, this equals the cost of goods available for sale, the cost of all the inventory which was available for sale to customers during the year, $824,500. We then deduct the closing, also called the ending finished goods inventory, of $48,000. But wait a second, where did we get this value? Similar to the merchandiser, we got it from the current assets section of the manufacturer's balance sheet. This is the finished goods inventory which is, as yet, unsold, sitting on the shelf at the end of the period. We then take that finished goods ending inventory of $48,000 and we deduct it from the total inventory that was available for sale throughout the period. By deducting it from the cost of goods available for sale, we get the cost of goods sold of $776,500. This is the value of all the inventory sold during the period, which is the amount that we used on the manufacturer's income statement as the cost of goods sold. You've now seen the method for calculating the cost of goods sold for a manufacturing firm, which shows up on the manufacturing firm's income statement. Don't forget, this is the amount of inventory that's been sold during the period. Here are both of the calculations compared directly. Note that the only things that are different is the naming of the accounts, merchandise inventory compared to finished goods inventory, and also the two accounts, cost of goods purchased for a merchandiser and cost of goods manufactured for a manufacturer. The differences are actually pretty minimal. However, the biggest difference is how the cost of goods purchased is calculated compared to calculating the cost of goods manufactured. For the cost of goods purchased, the merchandiser would simply add together all the invoices for the inventory which was purchased during the year. Calculating the cost of goods manufactured is far more complex and will be a topic of a future video. Thanks so much for watching.